Last time, I told you Larry Fink went on television and declared that Bitcoin's leverage problem was finished. And near the end of that video, I said there was something about Fink that almost nobody says out loud, and that it was the entire reason I made it. Then I gave it about 90 seconds and ran out of road. So I'm going to finish that thought today because it is the part that actually decides what your savings look like 10 years from now, and almost nobody in finance will say it to you plainly. Larry Fink is not building a Bitcoin company. Bitcoin is his on-ramp. It is not his destination. And here's where this lands, right up front, so you're not waiting 20 minutes for it. The same machinery being built to hold Bitcoin inside an ETF is being built to put your stocks, your bonds, your savings, and eventually your house onto the same digital rails. That is a genuinely useful upgrade in some ways, and I'll be fair about that. But it comes with one property nobody advertises. And once you understand that property, the case for owning the one asset that doesn't have it stops being an opinion and starts being arithmetic. Let me show you. Start with the fact that none of this is a leak or a theory. Fink has said it in public, on stage, in his shareholder letters for years. In January of 2024, the day after the spot Bitcoin ETFs started trading, Fink sat down on CNBC and said this. I'm giving it to you word for word because the wording is the whole thing. Quote, ETFs are step one in the technological revolution in the financial markets. Step two is going to be the tokenization of every financial asset. End quote. Read that back slowly. Step one. Bitcoin was step one, not the destination, the first step. And step two is every financial asset, not some assets, not crypto, every financial asset, stocks, bonds, private credit, funds, real estate. And he didn't say it once in a weak moment and walk it back. In October of last year, he was back on the same network saying, we are at the beginning of the tokenization of all assets. And then he added the part I'd underline. We have the technology to tokenize today. Not someday, today. And this is not a slide deck or a white paper. It is already running with real money. 2 months after that first quote, in March of 2024, BlackRock launched a tokenized fund called BIDL. It holds treasury bills and cash, and it settles on public blockchains. Today it holds about $2.4 billion, which makes it the largest tokenized treasury fund in the world, and it runs across 7 separate blockchains at once. Now widen out from just their fund. The entire tokenized treasury market went from roughly $1 billion in early 2024 to more than $15 billion this quarter, 15 times over, in about 2 years, in the quietest corner of finance. While every headline you and I read was about what the Bitcoin price did that week. And then hold that number up next to this one. 5 days ago, BlackRock reported its second quarter. $15.34 trillion under management. An all-time record, up from $12.5 trillion just a year ago, with $868 billion of new money walking in the door over 12 months. So sit with the proportions there. The tokenized piece is 15 billion. The firm building it manages 15 trillion. That is 1/1000th of one company's book. This is not the end of that story. This is the first inch of it, and you are watching it in real time. So when the man who runs that firm goes on television and says the dangerous part of Bitcoin is behind us, understand what you're actually watching. You're not watching a Bitcoin bull. You're watching the general contractor tell you the foundation passed inspection. Now here's the part the word tokenization is very good at hiding, and I need you to follow this one closely, because everything else depends on it. When people hear tokenized, they hear digital, faster, modern. And that part's true. Settlement that takes 2 days can happen in seconds. Fees come down. Markets can run around the clock. Those are real benefits, and I'm not going to pretend otherwise. But a token is not simply a digital version of a thing. A token is an entry on a ledger, and that ledger is controlled by somebody. And when institutions build these tokens, they don't build them wide open. They build them permissioned, on purpose, because regulators require it. And permissioned tokens come standard with a specific set of administrative powers written into the code. The administrator can mint new tokens. The administrator can burn them. The administrator can freeze a holder's balance. And in most institutional standards, the administrator can force a transfer, moving an asset out of your account without your key and without your consent. Those aren't loopholes somebody might exploit someday. They are advertised features. They are in the documentation. They exist because a regulated financial product has to be able to comply with a court order, a sanctions list, or a mistake, which is a perfectly reasonable justification. And it is also, precisely, a switch. I covered a version of this when I looked at what they're doing to residential real estate. I'm not going to repeat it here. What matters today is that this is not a real estate story or a crypto story. This is the design of the entire next financial system. So let's put you in it, because this is not abstract for a man with a paid-off house and a brokerage account. Today, your ownership is defended by friction. Your house is a deed in a county office. Seizing it means a process, a filing, a court, time, and a person who has to sign something. Your brokerage account is a claim, but unwinding it takes paperwork and days. That friction is slow and annoying, and that friction is also protection. It is the reason a mistake or an overreach can be caught before it's final. Tokenization removes the friction. All of it. That's the entire point, and it's why it will absolutely happen. But the same removal that lets a trade settle in 2 seconds also lets a freeze happen in 2 seconds. When your assets live as entries on a permissioned ledger, the distance between a decision somewhere and a consequence in your account collapses to nothing. And run that all the way out. A tokenized bond has an issuer who can issue more. A tokenized share has a company that can dilute you. A tokenized house sits in a registry, and a registry has a clerk, and the clerk answers to somebody. A stablecoin is a corporation with a mint button, and a central bank digital currency is unlimited supply, plus a record of everything you have ever bought, plus the technical ability to decide what you are permitted to buy at all. That is not a prediction of tyranny. I am not telling you a villain is coming. I'm telling you what the plumbing can do once it's installed, because capabilities that exist eventually get used, and nobody asks your permission when they are. Let me make that concrete, because permissioned ledger means absolutely nothing until it's your account. Picture your brokerage account the day after it gets tokenized. Monday morning, it looks identical. Same login, same balance, same statement in the mail. Nothing about your experience changes at all, and that is exactly the point. That's why almost nobody will object, and why this will happen quietly. What changed is underneath you. Your shares are no longer a book entry at a broker with a paper trail and a phone number you can call. They are tokens on a ledger, and the platform running that ledger holds an administrative key. Now, nothing goes wrong for years. Probably nothing ever goes wrong for you personally, and I want to be honest about that. But consider what became possible on that Monday that was not possible on Sunday. A freeze that used to require a court order, a filing, and days of process can now be executed as a database update. A restriction on what you're allowed to hold can be enforced automatically at the token level without a single person calling you. And a mistake, a wrong name on a list, a compliance flag that misfires, no longer takes weeks to reach you. It takes about a second. I am not telling you that is coming for you. I'm telling you that the distance between somebody's decision and your money just went to zero, and nobody asked whether you wanted that trade. And here's the thing I'd sit with if I were you. Every protection you have as an owner today, the slowness, the paperwork, the clerk, the court, all of that friction exists because somebody a long time ago learned the hard way that ownership without friction isn't ownership, it's permission. Tokenization is an efficiency upgrade that quietly converts the first thing into the second, and it will be sold to you, correctly, as a convenience. Now here's the part I find genuinely remarkable, and it's why Fink's comment last week mattered so much more than the price did. Wall Street did not build this infrastructure for tokenized bonds. There was no demand. Nobody was clamoring for it. They built the custody, the ledgers, the compliance layers, and the settlement plumbing because there was a stampede of retail and institutional money that wanted Bitcoin exposure, and the ETF was the only wrapper regulators would accept. Bitcoin created the business case. Bitcoin paid for the rails. And now that the rails exist and have been tested at scale with a genuinely difficult asset, everything else gets to ride on them. That is what Fink means by on-ramp. He is not lying to you. He has simply been telling the truth in a room where nobody was listening carefully. And when he said the leverage washout was behind us, he wasn't cheerleading Bitcoin. He was telling every pension committee in America that the foundation is stable enough to start moving the rest of the building onto it. Which brings us to the question I ended on last time. And now you can actually answer it yourself. When they finish moving the entire financial world onto those rails, which asset has no issuer? Go down the list. The tokenized bond has one. The tokenized share has one. The tokenized house has one. The stablecoin has one. The digital dollar has one. Every single instrument in that new system has an administrator with a key, a mint function, and a freeze function. Every one of them has a man who can make more of it or stop you from moving it. Bitcoin has no man. 21 million, fixed, forever. There is no committee, no boardroom, no emergency session that can vote another one into existence, and no administrator with a freeze switch, because there is no administrator at all. No servers to seize. Only a protocol running on tens of thousands of machines that don't know each other and don't need to. But here is the sharp edge, and it's the whole reason I made this video instead of another one about flows. Bitcoin held through an ETF is itself a tokenized claim. It has an issuer. It has an administrator. It has a custodian. Everything I just described about tokenized assets applies to IBIT exactly as much as it applies to a tokenized bond. The ticker is not the coat. So if the entire argument for Bitcoin is that it is the one asset with no issuer, then owning it through a product that has an issuer gives that argument away at the door. The exit is not own Bitcoin. The exit is own Bitcoin in the one form that has no administrator, in your own custody, where there is no key but yours. Now let me give you the whole picture instead of the flattering half. Tokenization is not evil. It is efficient, and efficiency wins, which is exactly why this is happening whether you or I like it. Faster settlement and lower fees are real gains, and plenty of people will be better off. And self-custody is not free. It puts you in charge of your keys, and if you lose them, there is no bank to call. It makes you a target for scams, and people your age get targeted deliberately, so no legitimate person will ever call and tell you to move your Bitcoin. Starting with a reputable custodian while you learn is a perfectly reasonable path. Nobody has to leap. And none of this is a reason to do anything dramatic today. Do not borrow to buy. Do not move money you need. Size it so a bad year never touches what you live on. This is probability, not prophecy. I am handing you a mechanism, not a prediction. So here's where it lands. Scenario 1. Tokenization rolls out roughly the way Fink describes. Most of your assets end up as permissioned entries on somebody's ledger, and the small slice you hold outside that system in your own custody turns out to be the only part of your net worth without an administrator attached to it. Scenario 2. It moves slower than he wants, regulation drags, and it takes 15 years instead of 5. Notice that in both of them, the direction is identical. Nothing in either version makes the one asset with no issuer less valuable to a person who spent 40 years saving. 3 signals to watch, all specific and checkable. 1. How fast tokenized treasury and money market funds grow, because that is the beachhead and the number is public. It went from 1 billion to 15 billion in 2 years. Watch whether it reaches 50. 2. The first time a major institution tokenizes something you personally own, a mortgage, a brokerage position, a deed. 3. What Fink and his peers actually do next, not what they say, because the money always moves before the microphone does. One line to carry out of here. They are building a financial system where every asset you own has an administrator. Bitcoin is the only one that doesn't, and only if you hold it yourself. If you want the live numbers I use every morning to track all this, the macro command center is at timtalksfinance.com. Free, and it's the same screen I build these from. I'll hand you the math and the mechanism, same as always, and get out of your way.